Thank you for joining us. I'm Ian Mindus, one of the client service associates here at Personal Wealth Strategies, and I wanted to extend a special thank you to all of us for joining our February webinar, and any of those watching back on the recording, which will be posted after the webinar. So with the new year coming and going, which seems to be so quickly, for me, it seemed like it was 15 seconds long. It's usually a time of reflection for many of us. And whether you're trying to learn a new skill or perhaps break a negative habit, reflection is usually followed by a change of some kind. So what we're going to learn today from our distinguished speakers is perhaps not within the theme of reflection and consistent change, but quite the opposite. Today, we will learn the ins and outs of developing an intelligent investment philosophy with evidence-driven investing, and perhaps even harder, learning the discipline to stick with that. And as we go through, David and Justin, if you have any questions, feel free to ask in the Q&A feature, as I'm going to monitor them, and we'll ask them as soon as we can. So first, I'd like to introduce David Balin. He is one of the financial advisors and founder of Personal Wealth Strategies. David graduated from Lehigh University in 1984 with his degree in finance and marketing. David, that's almost 40 years. I'm hoping you have a good
Thank you, Ian.
a good class
I was
reunion
just
coming up.
I was just thinking that we have to remove the date from that bio.
No, it's great. 1984 was my favorite year. Not that I was alive then. So
Thank you
after,
again.
yeah, after over a decade of experience in the financial services industry, David founded Personal Wealth Strategies in 1996. And since then, he's earned his designation as a chartered financial consultant and certified long-term care. Next, I'd like to introduce Justin Rice, who is the other financial advisor here at Personal Wealth Strategies with over a decade of experience. So Justin graduated from Rutgers University with his master's in biomedical engineering in 2015. At the same time, passed his certified financial planner exam and subsequently earned the CFP professional designation in 2018. Justin has since received certification in blockchain and digital assets and was the first advisor in New Jersey to receive the designation of certified student loan planner in 2019, and has since become a nationwide expert in the field. So both David and Justin are expert financial planners, and specifically for this webinar, have expertise in investment planning. So without further ado, Justin, why don't you bring us through the presentation?
Thank you so much, Ian, for that terrific introduction. I'm happy to be with you all today. Thank you for taking the time out of your busy day to watch this. Hopefully you're enjoying some lunch or taking a little bit of break. We're going to keep this brief and definitely get to your questions as well. So the first slide, we believe that every financial plan is a journey. And the question is, on that journey, do you have a GPS? Do you have a roadmap? Or are you wandering aimlessly in the forest, hoping to find a destination? And we believe having us as that GPS, the roadmap, the investment plan, you will get to your destination faster and safer than if you're wandering aimlessly, but you can decide that. We're going to dive right in today and go into the 5 pillars that are evidence-driven portfolios. And you may want to write these down, jot these down, but this is going to be the basis for everything that we're doing in terms of investments. And we'll put this in context throughout the presentation. But pillar number 1 is that markets are highly efficient. And we didn't say perfectly efficient, but highly efficient basically means that the current price of the stock is the best estimate of the actual value of the stock, meaning that if you're trying to guesstimate if that stock price is going to go up or down, so are trillions of other dollars flowing into that investment, hundreds of thousands of other people trying to guess the exact same thing, and that's a loser's game. And so it's much better to try to just accept that those markets are efficient, those prices are efficient, rather than trying to outsmart or outguess the market. That's pillar number 1. Pillar number 2, risk and reward are related. There is no reward without risk, at least not a great reward. And if you want more potential return, you need to be willing to accept more risk, which is likely fluctuations in your portfolio in order to have it pay off. Now, not all risks work out. That's what makes them risks. And so you shouldn't take more risk than you're comfortable with. So if you're comfortable with taking a risk and you're comfortable with the downside of the risk, then you'll definitely be happy if the returns decide to show up. Pillar number 3, diversification is essential. Now, everybody has heard the phrase, don't put all your eggs in one basket. Now, some people try to implement that a little bit differently, meaning that they'll have the same fund with 5 different fund companies. That is not diversification. But diversification at its core is a strategy in which you are saying a group of stocks is going to be safer than just one single company. And the more you can diversify the portfolio into unique areas of different risks, the better off that portfolio will be, rather than holding just any single investment. Pillar number 4 is looking at pursuing factors of returns. Now, academic research has shown there are specific characteristics of companies that give them a higher expected return, but as we've shown in Pillar 2, that does not come without more risk. But Pillar 3, you can use diversification to reduce that risk. But those factors of returns are important because following them and tilting the portfolio to them, you can get greater expected returns, albeit different than the generic indexes, over long periods of time, obviously making sure that it tracks within your risk tolerance. Those factors, we won't dive into them, but just to give you some examples: value versus growth, small companies versus large companies, profitable companies versus unprofitable companies, and so on. Looking at those characteristics, we can see what returns are expected with the given level of risk of those companies. And finally, number 5, focus on what can be controlled. We can't predict where interest rates are going. We can't predict where the markets are going. Most analysts back in last year in 2023 predicted the S&P 500 would be up about 1 to 7%. Nobody predicted that it would be up almost 25%. Back in 2022, they thought, bonds interest rates, they thought the Federal Reserve was going to raise them by about 1%. They ended up raising interest rates by over 4% that year. Markets are impossible to predict. And so rather than trying to anticipate or outsmart, you should instead focus on a strategy that you can control. And that's a strategy that we're going to be talking about today. David?
So before we get too focused on just the investments, there's really more to life than just money. What makes money important is what it can do for you. And it's a tool to help you accomplish your goals. The difference oftentimes of personal wealth strategies is we take the time to ask questions up front to find out what's important to you, and then take the time to really listen to your answers. Justin? We use this pyramid here to describe the collection of all the things in your life. So your investments don't really live in isolation. Sometimes we think of it that we do. We get our statement, we say things are good or bad based upon the rate of return that's listed on the statement. But in reality, they're not in isolation. It's part of your overall plan. And sometimes we'll talk to clients and they'll say that things are really bad because the markets might be down. Well, does that mean things are bad in your life because the markets are down? Does it mean you can't accomplish some of the goals that you had? Conversely, if things are good, does that mean that life is good? Certainly, life is better with good returns. I do agree with that. But this is not your entire outcome, your entire life. So when we look at your plan, we want to look at your whole life picture. We're going to look at your goals. And when we talk about goals, both monetarily and your life goals. And with new clients, oftentimes this is an interesting dynamic, because when we ask them about their goals, they'll typically list those monetary goals. And we'll say, isn't there anything else? And they're like, well, like what? And as we venture into the life portion of the client's goals, there's a little bit of a hesitancy. Like, why would you want to know that? And the reason is because, as I started to say, investments don't live in isolation. It's part of your overall plan. Justin? So it's important for us to look at all your goals and how they interact. Key considerations. Now, for most people who have opened up an investment account, whether it be through our office or any place else, whether it be at work through a 401k plan or through a mutual fund company, you probably have completed some form of a questionnaire that asks you questions like, how long do you plan to invest your money? How will you react if the stock market goes up or down? Uh, are you willing to take on more risk in your portfolio, or are you more of a conservative investor? But really, when we look at a client and try to develop the ideal portfolio for them, some of our questions aren't financial. We want to know about your career. We want to know about your loved ones, your desire to leave a legacy, personal risks that you might face, or things things that you want to impact through the way you live your life. These all become important and overlap each other in the development of your portfolio. Now, life really, as the slide says, isn't linear. Part of the advantage of partnering with an advisor is that you have someone to act as your guide, to bring you through opportunities and to face challenges. No matter where you are in life, you've worked very hard to get there. And now, as we look to the future, you want to be able to relax knowing that you have a proven, evidence-driven approach to navigate your way through life. And we call this approach design, build, and protect, because we're going to go through these three different phases. So first, let's talk about the design portion. In the design portion, when we first get to know a new client, we're going to talk about what's important to you. And as I mentioned, that may be, and it should be, more than just the monetary things that are important. We're going to design a plan that's customized to you. This plan is going to be a living, breathing approach, because as you go through life, these goals that you've set are going to be flexible and they're going to change. Perhaps there's a new family member that was born into the family. Perhaps a job has changed. Perhaps you may have dealt with a death in your family. All these things are going to change the planning work that we're going to do. Now, next, we're going to look to build that portfolio. And to build that portfolio, we're going to utilize academic research and financial science as the foundation, because we found that this will allow us to create a perfect fit to what you're trying to accomplish. Now, if you think about it, I said everybody has their own set of goals and objectives. That means everybody's going to have their own portfolio, because that portfolio is going to be based upon those goals and objectives. Along the way here, not only are we going to build this unique portfolio, we're then going to set attainable action items that look to be accomplished. You see, it's not a one day and you're done. As much as we might like to do that, just put it aside and say, okay, I have my investment portfolio all set up. The reality is there's going to be different steps along the way that we're going to need to accomplish to achieve our goals. And that brings us to the third section, the protection. And the protection deals with this idea that, you know what? Life happens. In fact, there's an old saying out there: if you want to make God laugh, draw up a plan. So we spend all this time designing the plan, building the plan. We need to protect the plan, because inevitably there's going to be a number of factors out there, both personal and those external to us, that are going to impact your plan. For our clients, personal strategies is going to act as your guide, and along the way provide you insights and education. I can't tell you how many times we've said to a client who's approaching retirement that they may be scared about different factors about retirement, but as unique as it is to them, we've helped hundreds of clients retire. We've seen these types of reactions, and we can help add guidance to those decisions. Yes, the first time you do this, you're going to be going it alone without an advisor, but working with an advisor and having an evidence-driven portfolio along your way is going to help to make the ride a lot smoother. Justin?
Great. Thank you so much, David. And what are those fundamentals of investing, those building blocks that we can utilize? And there's two key core building blocks. Now, these aren't the only investments that you would be in. There's definitely other things, but the building blocks of a portfolio starts with stocks and bonds. Now, stocks, you are purchasing ownership in a company. And so you actually have real ownership of a company. If the company does well, you do well. If the company pays out a dividend to its shareholders, you receive that dividend. Now, a bond, on the other hand, is also called fixed income, is considered a loan, but you're not lending the company, you're not lending, you are not getting a loan, you're actually lending the company money and receiving interest payments in return for that or other additional income with a bond. Now, in general, stocks are referred to as riskier than bonds on average, and therefore, back to the pillar of evidence-driven investing, should yield us a higher expected rate of reward. And this has proven over time. As you can see, going back all the way to 1927, the hypothetical growth of just $1 through 2022, you can see the dark line at the top there is stocks, the blue line being bonds, and then the gray line, inflation. And so bonds, yes, has outperformed inflation since 1927. However, stocks have outperformed much, much more. But can you deal with the volatility of those stocks in the meantime? Now, looking specifically at stocks, typically somebody that's watching the news or has been following it a little bit will recognize the stock indexes. So the S&P 500, so Standard & Poor's created this index of 500 companies here within the US, are the largest companies here in the US. And that's what most people see as their barometer of stocks. Yet it goes much broader and deeper than just that. For example, here within the US, besides those 500 companies, if you expand it out, there's almost 3,000 companies that you can actually invest in just here within the US. And then you can go internationally into other developed countries and add 4,000 more companies, and then go to emerging markets and even 4,000 more. And so there's way more stocks to invest in beyond just the S&P 500 or the Dow Jones or the NASDAQ that you might see reported on the news on a daily basis. And it's hard to predict where those returns are actually going to come from. And seeing the whole world as an investment versus just one particular index, we believe with that diversification, you're going to have a smoother and better ride over the long term. As you can see here in North America, which includes US, Mexico, Canada, about 63% of the world's market capitalization is here in North America. But that means almost 40% is outside of North America, in Europe and Asia and some other countries as well. And so having access to those markets, those diversifications, is going to be critically important when we're seeking that diversification from a stock perspective.
So investments become the engine of your life's journey. And whether you're in the phase of your life right now where you're looking to grow your wealth, or you're perhaps retired and now looking to protect it, as I mentioned earlier, every portfolio is going to be uniquely designed. And that's because not only do we have different goals that we're trying to accomplish, but also because people react differently to economic, political, and societal risks. The way we view it, this is an all-inclusive way to look at the idea of diversification. Now, using this evidence-driven approach, we differ from the way most professionals design portfolios. Justin a moment ago mentioned that the typical building blocks of a portfolio are going to be stocks and bonds. But at Personal Strategies, we tend to look beyond that traditional thinking to evaluate the risks and how those risks affect the performance of those stocks or bonds. By using an evidence-driven portfolio, you're going to accomplish things a little bit differently. Number one, that portfolio is going to be built on decades and decades of research that looks to understand the risks that drive returns. So as Justin mentioned a moment ago, if we were looking for an investment that had no risk, In economics, this is referred to as the risk-free rate, and it's typically the proxy for that is a 30-day treasury bill. If you put your money into a 30-day treasury bill issued and guaranteed by the US government, the assumption is the government is not going to go bankrupt in the next 30 days, and therefore you're guaranteed to get all your money back. But the 30-day treasury bill offers very little reward. And the reason for that is because you take no risk of loss. And by only purchasing 30 days, you take no time risk either. So by understanding the risks that are derived by adding time limitations or volatility into the investment, we have different results. A second piece of the evidence-driven portfolio is we look to capture the returns more effectively, given the tolerance that you might have for that risk or that volatility. We're also going to strategically blend your investments and tilt towards higher returning assets. Finally, when we're looking at a person's stock portfolio, we're going to look to balance the risks that stock present with only the highest quality bonds that are available. Now we're going to tilt your portfolio on the next slide. We're going to tilt your portfolio and look to derive benefits from that. So based on academic research, we're able to group different stocks into collections because of their unique characteristics. And what we're looking for are stocks that offer better rates of return over the long run than others. When we've identified those stocks, we then tilt or emphasize those stocks within an investor's portfolio. And on the slide, you'll see the three main tilts that we'll put into a client's portfolio. The first one is that we know that over the long term, smaller company stocks will produce a higher rate of reward than larger company stocks. Now, that's not true every year. It's not true every month, but it is true over the long term. And the reason is quite intuitive. If a small company offered less of a rate of return than a larger, safer company, why would anyone ever invest in that smaller company? So we know historically, smaller companies are going to offer higher rates of reward than larger companies. Secondly, we know that stocks that you buy with a lower price typically offer a higher rate of reward over the long term than stocks that you buy at a higher price. Again, you may say, hey, Dave, tell me something I don't know, right? If I have to pay a lot for something, there's less room for growth. So I want to buy something low and sell it high. Well, that sounds kind of pretty obvious, David. Where's the insight in that? Well, you'd be surprised how often people look to buy higher priced stocks simply because it's newsworthy, or it seems more glamorous to own a company that has a higher price. Finally, we're going to tilt towards companies that have better financials. And better financials you can translate to companies that make more money and are more profitable. Because companies that are more profitable historically tend to stay more profitable. Again, a lot of this is probably not shocking to you, but it's amazing how few investors implement these strategies. Now, on the next slide, we can show you how these tilts become so important. Because by blending stocks and these high quality bonds, we can improve the outcomes that you're going to receive during your retirement years or any time that you're really taking contributions. And on this chart, you can see the black line, which represents a portfolio made up of 100% stocks, and the blue line, which represents a portfolio that's made up of 60% stocks and 40% bonds. Now, if I asked you the question, which one of those two portfolios do you expect to produce a higher rate of return? You would hopefully answer that the portfolio that's made up of 100% stocks is expected to produce a higher rate of return. And that is true. It is expected to produce a higher rate of return. But what's not often noted is it gets there by producing a higher level of volatility, more ups and downs along the way. And when you're taking withdrawals and having high ups and downs, it creates a drag on the portfolio. So by blending in bonds to temper volatility, a portfolio is going to produce a better outcome then a blended portfolio will produce a better outcome than a portfolio made up of simply 100% stocks.
Okay, so what are those optimal mix of investments? Now, there's a lot of potential, funds, mutual funds, exchange traded funds, closed-ended funds. How do you select it? And so we do a filtering process of the investment universe to get those funds, those asset classes that truly represent the best way to access the various companies that we're trying to invest in. And so through this filtering process, we are able to eliminate a lot of different funds that have some downsides. So step one is to first eliminate funds with any hidden loads, 12b1 marketing fees. We want to have the cleanest share classes possible, and so we can eliminate all of those hidden fees there. Step two, as we narrow down the universe even more, we're going to only include funds that are broadly diversified across various stock sectors or geographic regions that we're looking to access. Next, we're going to then look at that academically sound investment strategy. And so there's funds that specifically utilize that academic research that will tilt towards those companies that are profitable, less expensive, and smaller as well. Then looking to engage those fund managers, developing a deep understanding of actually what their process is, their best practices, the teams that they're running, to make sure that they're going to do what they say they're going to do within their funds. And then finally, what are those funds that are most effective at consistently capturing those returns compared to, again, the costs? Because all things being equal, we want a fund that is less expensive than more expensive. That's very widely shown in the research that you're going to be better off paying less than more. That's clear. But what is that more getting you? So all things being equal, once they've passed all the filters, then we can look at relative to the cost that they charge. And then finally, what is that tradability of the fund as the investment universe gets smaller and smaller? What is the tradability? Is it liquid enough? In volatile markets, are we actually, and we need to trade, are we going to be able to get out? Or are we going to be stuck in something? Because that illiquidity is another potential hidden risk. And so we want to make sure that the tradability of the funds, even if they check all the other boxes, are still there.
So you've worked hard to get to where you are. We know that it's the case. But there's all kinds of risks out there. Creeping inflation, and boy, did we learn about inflation over the last year and a half. The market ups and downs, the unexpected turns in life. We really need a way to protect our assets as well as to grow them. But there is good news out there. And that is that the science is already out there. The financial knowledge is already out there in the world of academia that you can utilize to manage your portfolio rather than to work off of guesswork. Now, at Personal Wealth Strategies, we're going to consider your entire financial situation. We're going to look to identify your objectives and your income requirements. We're going to look at your willingness to take risk. And we use those characteristics in order to tailor a plan unique to yourself. And by considering the entirety of your situation, we can tailor a solution that requires the least amount of risk in order to achieve a financial objective. Now, let me repeat that because you're probably used to hearing we're trying to get the highest rate of return given a level of risk, which is a true statement as well. But once you have an objective in mind, we flip that on its end and say, what's the least amount of risk you need to take to achieve your objective? After all, why would you take more risk than necessary? Additionally, we're going to utilize a tax-sensitive planning process to analyze your existing accounts, your income, the tax implications, and review each of your current holdings. Risk can mean different things to different people. I oftentimes joke about the little old lady who, upon hearing that she has way too much in her savings account at the bank, we talk about putting money into a government bond. She might think, gee, does the government bond have FDIC insurance? Because if not, that sounds pretty risky to me. Where another investor might think, A government bond, why would I put my money there? There's so little risk, I can't get enough of a reward. It's just two different ways of looking at the same scenario. Different people fear different things. Some people are going to fear the ups and downs that come with market declines and potential for portfolio losses. Some people don't want to see their portfolio underperform one of those benchmark indices. Others are going to fear not having immediate access to all their money in case of an emergency. We know that in managing the portfolio, onto the next slide, Justin, we know in managing the portfolio, we have to pay attention to taxes. Taxes are a very real burden that we face. And if we were to ignore taxes, we would work in a very inefficient way. But by putting tax inefficient investments into tax efficient accounts, we can potentially reduce those tax burdens. This is a strategy called tax location. Traditionally, when investors have multiple accounts, and in this slide, you're going to see an IRA account, a Roth IRA account, and a taxable account. Traditionally, when people have different types of accounts, they will use the same asset mix in all three of those accounts. Say, for example, they might put 60% of their money in stock and 40% of their money in bonds, and they do so in all three places. But strategic asset placement talks about the idea that different accounts have different tax liabilities, but they also have other tax benefits. And by using a tax-aware investment approach, we're able to put different assets into different accounts to take advantage of those tax benefits. Now, what you get is three accounts that over time are going to have three different rates of return. For some people, that seems very uncomfortable. But what we're trying to achieve is the highest overall portfolio rate of return on an after-tax basis, meaning we care less about how much your IRA did versus your Roth IRA and more about how the three accounts performed in totality. Because after all, it's really not a matter of how much you make, but it's a matter of how much you get to keep. So in the next slide, we look at the tax efficiency of investments in different asset classes as the first step, and then rank them based on the percentage of the return that's lost to taxes. So for example, if we were to look at municipal bonds are very tax efficient, and very little of the return is going to be lost to taxes. That is a tax efficient asset. On the other hand, corporate bonds that pay interest, taxable interest, are very tax inefficient because the interest paid by those corporate bonds is going to be subject to ordinary income taxes being greater than capital gains taxes. So we're taking current income, we're subjecting it to the highest tax rate available, and we're doing so on an annual basis. That's really tax inefficient. So there is two examples of asset classes, both bonds, where we can use asset location to determine where we want to hold these different assets. So for example, we can take the corporate bonds that will pay a higher interest rate than municipal bonds and put them into an IRA account, because an IRA account is tax deferred and I don't have to pay tax on that interest. And there I've taken a tax inefficient asset, put it into a tax efficient account to eliminate the need to pay tax on that interest at this time. And you can see on this chart here that the effects of this, if I had invested $1 million at the beginning of time and left it invested for 10 years, the outcome would be a difference of $46,000. Now, maybe $46,000 doesn't sound like a lot to you. It does to me. But if $46,000 doesn't sound like a lot to you, think about this. These two portfolios, the one represented by the blue line and the one represented by the black line, are invested in the exact same investments. The difference that produces the $46,000 is that strategic asset location. So the end result of all this is that we put together a personalized fit plan that's going to fit your needs and your ability to tolerate the ups and downs that come with market investments. And utilizing these evidence-based strategies, we're going to be able to produce a greater expected rate of return after taxes than traditional investment strategies. Just
And so how do we manage this ongoing? Because it's much easier to represent and say, yes, we should be buying inexpensive companies. We can tilt towards small companies. But then when stuff is going wild, the news is saying, the streets are on fire, the stocks are falling, you need to sell and get out, our emotions can potentially get in the way. And although intuitively investors know that we want to buy low and sell high, our emotions will tell us the exact opposite. As things are going well, we're optimistic, we're excited. That is when our emotions are saying, yes, let's buy. But that's when prices are typically at their highest. Then as stocks start to fall, we're starting to get, in 2022, inflation is much higher. The Federal Reserve is raising the short-term interest rates to help slow it down. We're seeing markets falling, bond prices falling. What's going on? That's when our emotions will say, yeah, it's time to get out of here. And what you just did was you bought when things were high and sold when things are low. And then you'll wait until things settle out, are safe, and then you'll buy back in at another high point. And it doesn't matter what investments you're buying. If you let your emotions dictate when you're buying those investments, you're not going to have the results that you are hoping for. And so when we're looking at managing the portfolio, we try to remove emotions from that mix and strictly base to a strategic approach. And so here we're going to go very simple, very basic, of a target allocation of 50% stocks and 50% bonds. And now let's say that over time, those stocks are increasing faster than bonds. I'll use a good scenario where things are actually going up. And stocks in normal times should perform more than bonds. And so it wouldn't be a surprise that the allocation towards the stocks will grow, assuming that we're not doing anything. And so because of that, as you can see in that second image there, now your stocks have gone from 50 to 55%, where your bonds are now at 45% of the portfolio. And so what do? We use rebalancing, meaning that we're going to sell stocks. And by the way, when selling stocks, what we're doing there is we're selling them at a relative high point to buy bonds at a relative low point. And so we're taking emotions out and doing potentially the opposite of what our emotions will tell us to do. Because if stocks are going well, that's where we're making all our money. Why the heck would we sell the stocks? Because they're doing so well. When the strategic rebalancing will say, no, the portfolio is now actually riskier because now you have more stocks than bonds. Let's take from those gains, buy into the bonds, level out the risk, keep the portfolio in line with your tolerance for risk, and have those better long-term, smoother results. And finally, things aren't always going to grow. We know things are going to be volatile, but how can you turn those lemons of down markets into lemonade? And that's when we can look to actively turn those losses into tax benefits. And so this doesn't happen within IRAs, but it does happen within taxable accounts. If your investments are falling, one of the things that you can do are sell those assets, but buy something that is not directly the same, but potentially similar to that asset class. You're not out of the market because we don't want to sell and be fearful. We want to sell for tax strategy, lock in the loss, buy something similar. And then with the rules, you could actually either stay in that new investment, go back into the old investment 30 days later, but there's some strategy there. But then now you can use that loss to reduce your tax bill. You can also use it to eliminate other gains in the portfolio. And so potentially there could be a time when you've got, let's say, company stock or another investment that you've held for a long time that you're holding on to just because you don't want to sell it because the gains are going to be taxed. You can say, hey, in this area of the portfolio, let me harvest some losses so then I can have the permission to sell some of this stock so I can further diversify that in my portfolio. And it's not going to cause a huge tax bill, which is what you were concerned about in the first place. And then life changes as the portfolio changes. And so your goals may change, your life may change. You may have a new baby, a new grandbaby that may shift your perspective. You may want to retire earlier than you expected to say, hey, I can't handle this job anymore, or else I'm not going to be here. And so we can adjust the portfolio to what's going on in your life to make sure that the goals that you want to achieve, because at the end of the day, I want to repeat this, nobody cares about the investments. They care about what the investments can do for them in order to achieve the goals that they want. And so focusing in on rates of return and these various investments is all very sexy. But if you can't achieve what you want to, then it's all for naught. And so incorporating both together, and what you see here are different probabilities of success. So you have the base case scenario of retire at 65, a very good probability of success, continue to monitor. But what if you want to retire 5 years earlier than that? Potentially not. Only a 50-50, a coin flips chance of that actually working without needing to make adjustments. But potentially retiring early is more important to you than having the home. And so by downsizing the home, you can now increase the probability of success to over 90%. And so it's these type of adjustments in your life, your strategy, along with the portfolio that need to be focused on hand in hand, not just in silos, so that you can get the results that you're truly looking to get. And that's where the value of an advisor truly comes in. Dave, you want to talk about this slide?
Yeah, so just like you said, the benefits of an advisor truly come in. Hopefully we've made clear today that as important as it is to get the highest rate of return you could possibly get in your portfolio, there are benefits that are going to be derived beyond just returns. And this slide represents a pretty interesting study. It was done by Vanguard. And when you think about Vanguard, you don't typically think of a company that's going to be out there touting the importance of working with an advisor, because we all know Vanguard to be a self-service company. But what Vanguard found when they did their study was that an advisor can add up to 3% per year of added value to your portfolio. And they do so through the implementation of your strategy. And you'll notice on the first item listed, suitable asset allocation is assigned a return of 0%. And they read the footnote, it's because they couldn't even quantify this. They said, yeah, it's really important that you end up in a portfolio that matches who you are, but we can't quantify how much an advisor can help you here. So they assigned it 0. Thought that was kind of interesting. They said it's real important, but we're not going to assign it any value. But looking at a cost-efficient way to invest your money, in other words, looking at the expenses of the different funds in your portfolio, investments inside of your portfolio, adding that rebalancing element that Justin spoke about, of moving monies around as the portfolio drifts, adds another 0.14%. And if you add those two together, 0.44%, the 0.30 and the 0.14, 0.44% is the return that an advisor can help you in getting you into the right portfolio. And with the advent of artificial intelligence, people are always saying, what can my computer do for me that I couldn't do on my own? It's going to be about a return of about 0.44% if you have a computer always looking at things and making the exact decisions that you should be making in terms of your investment portfolio. It's the other elements where the advisor becomes really important. And that is through the behavioral coaching, the idea of trying to keep you focused on buying things that are at low prices instead of chasing those that are already high. The idea of the asset location to reduce the tax burden that goes along with the returns that you get. Sometimes I'll say to clients as an analogy, if you had an account that made 10% and your neighbor had an account that made 9%, who made more money? Well, the knee-jerk reaction would be, I made more, I made 10%. Well, if your 10% was subject to taxes and their 9% was not, now who do you think made more money? So the asset location question is really important here. And then finally, the spending strategy. When you're starting to take withdrawals, do I take my withdrawal from my IRA account, my 401k account, my Roth IRA account, my investment account? Do I take Social Security first? Do I take Social Security later? All those questions have a real implication on the returns that you will get. So this idea that Vanguard, of all people, thinks that working with an advisor can add 3% per year to your portfolio, I find to be very interesting. So to kind of bring it all home here, ultimately, like any journey, the experience for you is not going to be limited to whether or not you successfully arrive at the location. It's not whether or not you successfully achieve your goals. That's a given. If you didn't achieve your goals, then this whole process might be thrown out the window. But what is important, as much as achieving those goals, is the turbulence you face along the way. And simply saying I got a high rate of return and ignore all these other factors that we spoke about is going to create a very turbulent flight for you, and one that you will not be comfortable with. And what happens when you're not comfortable is, unlike an airplane, you're going to jump out, you're going to parachute out, you're going to say, I'm not doing this anymore. And when you do that, you're going to jeopardize the goals that you've established. So to create a journey that's going to be a smooth ride, that you're going to know that your probability of success is going to be high, and that you're going to achieve your goals and objectives, is what it's all about. So Justin, I believe you have something that our clients and prospects might be interested in hearing about.
Definitely, David. Yeah, and we will get into the question and answer. So if you have any questions, feel free to type them in to the Q&A feature. But I want to have some next steps, because it's nice to learn all of this, but what do we actually do and implement it with is the question. And so what we're offering today is a financial acceleration session. And that's no different than the typical session that we would offer for a new potential client that's kind of investigating what it looks like to work with an advisor. We provide a tremendous amount of value at that meeting, even if we don't end up being a fit together. And so we do offer that, and we've had follow-up sessions from different webinars and had people book meetings. But for this webinar in particular, we want to do something a little bit different. And in addition to the financial acceleration session for the first 5 people, so the financial acceleration session, unless we change things, will be there. That opportunity will stay. But to have some reason to act now, we want to give the first 5 people something special of real value. The first thing that we're going to give, and by the way, if you're a current client, you will get all of this as well. And if you haven't gotten this, we will look to review that in your next review meeting if you want to. But the first is access to Money Guide Pro, our financial software, with an additional training that's outside of the financial acceleration session. So it's actually 2 sessions, additional training on Money Guide Pro specifically for your situation with none other than Ian, who is on the call today. The second thing that you will get is the portfolio gap analysis. And so we'll look at where your investments are currently invested within your 401k, IRA, and compare it to where we would put them based on the academic research. We'll show you where your costs currently are, how diversified are you your bonds shorter term, longer term, and where they differentiate. And so we'll be able to have a 20+ page report of all the different areas of your investments, showing exactly where they line up. And we'll give that to you for free, no strings attached. So you have that as a reference, and you can make allocation changes based on that report if you wish. And then finally, a personalized tax report. And so as you can see, taxes are a huge theme here. And having a tax efficient portfolio and tax efficiency in general is very important. And how do you know if you're not reviewing your taxes? And I'm not just talking about reviewing the 1040, which is the document that you actually file your taxes with. I'm talking about a specific tax report that turns that complicated IRS jargon into English, and then has specific observations of action steps that you can take to reduce your tax burden and better your overall situation. And then the final thing for the first 5 people is a bonus specifically for business owners. And that is a business acceleration session. So actually 3 potential free sessions of value: financial, business, and financial software Money Guide Pro. And that business acceleration session is with Unblinded, one of the co-founders, either Adam or Fernando, will be able to take you, talk about your business goals, where you want to see them, so that you can increase your financial abundance in less time with more impact in the world. And I will tell you, if you've been to any other business coaches, there's no more impactful free session than you will ever find. And in fact, probably paid session as well for some of the other coaches out there. So that is a huge bonus benefit as well. So that is it. I will drop a link in the chat as we look to Q&A. Ian, can you take over the Q&A as I look and drop the link in the chat?
Absolutely. So the first question we have is, do you do this portfolio management through Woodbury, then through Schwab? Before either of you answer, I just want to make sure Woodbury has rebranded into Osaic Wealth Inc. So nothing structurally has changed for you. It's just on correspondence, you might see Osaic Wealth Inc. instead of Woodbury going forward. Not you may, you will see that difference. So David, do you want to answer that?
Absolutely. So what you can look at is the different layers. I guess the short answer is yes. But as Ian mentioned, Woodbury has been rebranded into the name Osaic, which works as a registered investment advisor. We pay that company, we pay Osaic, to perform due diligence and compliance work for us, so that you'll see contracts will oftentimes have their name on it. You'll see them reach out to you periodically to ensure that the data that we have in our systems are correct, but they're not involved in the investment decision. Schwab or Pershing are the two companies who we use as custodians. So their responsibility is to safekeep your money. So if you get a statement that says you have $846,322.15, and you say, great, send me a check, Schwab or Pershing are guaranteeing that they have those monies. And just to show the importance of working with strong companies like that, you have to think no further back to the Bernie Madoff story, where Bernie Madoff custodied his money. And when people got their statements, it was Bernie guaranteeing that they get their money back. And well, how did that work out? So we have Schwab and Pershing staying behind it. The investment decisions are very highly influenced by the work of Buckingham Strategic Partners. And Buckingham Strategic Partners is getting their academic research through companies like Dimensional Fund Advisors, through the academic channels at places like Dartmouth, University of Chicago, Wharton School at University of Pennsylvania. And we use all that information for our planning teams to put together these strategies that we've spoken about. I like to differentiate what we do. I sometimes call the rest of the world Wall Street planning, which is all about the flash and glitter and telling you, here's the next hot stock, to academic-based planning, where we say there's been research into the strategies that we're using, and we have some foundation to what we're recommending.
Perfect. So the next question is, if I am taking withdrawals now, is it better to take them from lower taxed accounts, since rates are likely to increase in the future?
That's a good question. David, you want me to take it, or you want to take it?
Shit, why don't you go? I took the first one. You can take the second one.
Yeah, I mean, so anytime we're looking at withdrawals of where to take portfolio, it really is going to come down to the goals that you're trying to achieve. Meaning that, are you just looking for meaning do you just have enough money to finish out your retirement, or are you looking to leave money to the next generation? And how do you want them to be taxed? Because if your next generation, are in a higher tax bracket than you or a lower tax bracket than you, that could also change the situation. So in general, what we're looking at from a tax perspective, and then we're getting kind of deep into what we can look at for an overall plan going forward. But generally, right now, taxes are lower than they've been in a relatively long time. There's going to be the sunset of the Tax Cuts and Jobs Act in 2026, where we'll, as of right now, if Congress doesn't do anything, we'll see an increase in ordinary income taxes. And so if you're taking income out of an IRA that's going to be fully taxable at ordinary income, potentially it may be better to take more out of that now, so that you can take less out of it later on when taxes increase. But you'll have to run those different scenarios to know not exactly, but with high probability of what's going to be best in your scenario. Because on the flip side, if you take everything from the high tax now, you might have pay no tax in the future, which would be suboptimal as well, because you've taken all of your money out of the taxable now. And how taxes work is the more that you realize in 1 year, the higher the percentage will be. And so if you're going to have $1 million in your IRA and say, well, I don't want to pay those higher taxes later, let me take my $1 million and convert it over into a Roth IRA. Well, what that's going to do is you're going to pay the taxes as if you earned $1 million in 1 year, and you're going to pay at the highest rate, when in reality you could have dripped that out over a series of years at a much lower rate. Even though tax rates are higher, your tax rate, your personal tax rate, could be lower because you're taking less out over a longer period of time. So hopefully that helps to answer that question.
Yeah, I would just add on that, the way to answer that question is, what's most important to you? Paying the least amount in taxes this year, paying the least amount of taxes over your lifetime, or paying the least amount of taxes to your family through generations? And the way you answer that question will help us to answer the other question. One other thing I'll add on is talking about how investments don't operate in isolation. One of the things you have to pay attention to, and this catches a lot of retirees by surprise, is depending on how much your income is, will determine how much you have to pay for Medicare. So the correct answer to produce the lowest tax burden to you might be the one that produces a higher Medicare premium through the income-related monthly adjustment amount. If you don't know what I'm talking about, that means you probably have avoided it. Because if you get hit with a surtax, you know all about it.
Yeah, most of everything we do on a daily basis, a simple question turns into a more complex and detailed answer, for sure.
And if you're looking for answers to all of your questions specifically, that's what the acceleration session will do. And if you're like, hey, I'm a client, we'll definitely talk with that. But if you know somebody and you're like, oh my gosh, I can't believe they're giving away all this value that I might not even been taking advantage of, we will have the recording for this webinar sent out to those that are registered. And we will still limit it to 5 people. So if you're here live, you got a head start advantage, but we will look to send it out the recording, and then have you can share it from there if you have somebody in your life that you want to see this.